Good morning, Larry. Thank you
Good
very
morning.
much for accepting our invitation to present to our group on a Saturday morning. And thank you very much for everyone attending. So we're going right into our feature presentation, but before Larry starts for us, I would like to give a little bit introduction about Dr. Souza's background. So Dr. Souza has 32 years of experience in the commercial real estate industry. Prior to working as managing director, institutional sales, finance and research for Brookwood Starboard, as well as the VP for data analytics and director of research for GreenSpark, Dr. Souza is also a registered representative and investment advisor, as well as a real estate consultant and licensed California insurance agent. He is also a real estate investment broker, providing economic and investment consulting services to retail and institutional real estate investors. At the same time, Dr. Souza is adjunct professor for finance for University of San Francisco, and he just told me that he's also teaching full-time at St. Mary's College of California for the Schools of Economics and Business. In essence, Larry has profound experience in studying real estate trend in Bay Area and nationwide. So without further ado, may we now invite Dr. Souza to start his presentation. Thank you, Larry.
All right, test. Can you guys hear me?
Yes, now it's good.
Okay, great. I was just saying that you and I have been working together for, over 20, probably 25 years now. It's always been great to work with you and meet your clients and your prospective clients and your friends. And I always learn a lot from the process. And again, I always appreciate the opportunity to make my presentation to you and your colleagues. I'm going to be talking about, I call it the political philosophy and economy of commercial real estate investment. And I think that now it's probably even more relevant of a discussion because we can really see the policy impacts on the economy, not only a social policy or cultural policy, but definitely fiscal and monetary policy. And I will be having some discussions on what the implications and ramifications were of over-accommodative fiscal and monetary policy over the last year, but really over the last 10 years since the financial crisis, and where we are today, and where the opportunities and the threats are, not only today, but also going forward within the next 36 months. I always look at real estate investment as something similar to big wave surfing. You have to be really good at it. You got to be smart. You got to be forward looking. You got to be constantly training. And you may get taken out, by a large set every now and then. But if you're good and you've been training and learning the whole time, you can basically pop back up, swim back out, and catch another few waves. So it's very, very similar. I do want to make some disclaimers. I am not making any investment recommendations today. I'm not making any legal or accounting recommendations. Even though I am a licensed real estate broker and advisor, I'm not making any recommendations whatsoever. And if you need any investment advisory, legal, or accounting advice, I would consult those licensed professionals. And if you need referrals to those types of individuals, I'd be more than happy to give you at least 3 to meet compliance for you to be able to get the help that you need. My cat Zachary told me to say hi to you guys this morning. So hi from Zachary. He wishes, he could be here, but he's in the other room sleeping off the breakfast I gave him this morning. Efficient real estate and security capital markets require strong public and private sector cooperation, disclosure of government and corporate financial conditions, and institutional and individual investor confidence in both the financial and political institutions. This is basically a hypothesis in which I use to test not only country risk and institutional development, but also capital market and real estate capital market development on a global basis. If this hypothesis is violated, what you are going to see in these countries is underinvestment, misallocation of resources, underemployment, underproduction, low and falling real wage growth, and the worst case scenario, low and or falling standards of living and social welfare. And we've seen it in the United States over the last 10 to 20 years. And we've seen it recently in the responses to COVID that have basically showed us that our healthcare system and our educational systems have failed due to lack of attention by policymakers. What we're seeing in the United States right now, oops, I'm sorry, I need to move this. In regards to presidential and congressional politics, we just came through a presidential election and a congressional election where you saw that the House and the Senate had a slight majority from the Democrats, which actually allowed for policy alignment amongst the three branches of government, which is a very rare phenomena. We usually operate within a divided government framework, but with an alignment. The probability of getting social programs and social welfare policies such as housing, healthcare, education, maybe immigration policy moved through Congress is highly probable, particularly if the three branches are controlled by the Democratic Party. This is based off of my research. It's not opinion. And I will be publishing a book on U.S. housing policy, politics, and economics very soon, which basically lays out and proves empirically that this is the case. Now, with response to COVID-19 outbreak, the U.S. is being confronted with existential policy issues, such as healthcare and the need for universal healthcare, an economic crisis. We still have high underemployment and very low labor participation rates, particularly for minorities and for women in the labor force. We are also confronting international foreign relation crises, and you can see that between our relationship with France and our relationship and our botched exit from Afghanistan. These all combined require decisive policy innovation, solutions, and execution, and cannot be administered under current and future divided governmental institutional arrangements. The American people decided in November that they wanted a united political governing structure under the Democratic Party, and we may see less institutional market failures and deconstruction if we can move forward with a more united governmental institutional structure. Real estate prices are highly correlated to the business cycle. And what we've witnessed since the financial crisis is an over accommodation of monetary and through the pandemic fiscal policy. The over accommodation of monetary policy drove interest rates again to zero, particularly on the short end of the yield curve. And actually, the Federal Reserve started to pull down medium and long-term interest rates, which has benefited significantly the real estate markets, both residential and commercial. The issue with over-accommodated monetary policy is one is the ballooning of Fed's balance sheet, which is approaching $9 trillion. Sorry, yes, $9 trillion. And over 20 years ago, the Fed's balance sheet was around $900 billion. So the size of the balance sheet is not only an issue here in the United States, but also on a global basis. And the only way to unwind that balance sheet is either to let the securities mature or to create inflation to monetize the debt that they have purchased, mainly from the federal government. And currently, the amount of securities that the Federal Reserve is buying of U.S. sovereign debt, along with mortgage and residential mortgage-backed securities, again, is unprecedented. And the only way to deflate the balance sheet, that I can see, is through inflation, which may benefit some sectors of the economy and some investors, but will probably wipe out a significant portion of the middle class and throw millions of people into poverty. On the fiscal side, we had another trillions of dollars that were appropriated through Congress, and more to come, which is just going to create more structural budget deficits and higher debt in the future, which unfortunately your kids and grandkids and great-great-grandkids will be responsible for. And again, they will not be able to pay that off through higher taxes or higher production or productivity, so it will have to come through inflation. And you're seeing inflation now for the first time at a level not seen since the 1970s, although inflation, if you looked at how it's measured, grossly underestimates the true inflation rate. So inflation and the potential for stagflation within the next 12 to 24 months is highly probable, or it's probably here. These are basically the existential issues that we are going to have to deal with. And the Federal Reserve this week, under Jerome Powell on Thursday, basically stated and guided very clearly, along with a coordinated effort with other central banks across the globe, that they are now going to implement a tapering, so a pulling back of buying the bonds, and they will start to raise interest rates starting in November through 2022, and they will end in the first half of 2023. They've stated it. The yield curve has already shifted up. The 10-year Treasury rose 10 basis points, one of the highest and fastest moves in the 10-year and in years. And if the yield curve inverts at any point in time within the next 12 to 36 months, based on history, the stock market will peak in less than 12 months, and we will be back in a recession in 24. So my forecast, or probable forecast, could be, if the yield curve inverts in 2022, the stock market and the real estate markets could peak in 2023, and we may experience a recession in 2024. Hopefully it will be a mild recession. And if that's the case, the recession will probably last a year or two, and we will be back into the recovery peak phase of the business cycle and the real estate cycle between 2025 and 2030. There is your tactical investment strategy. There is your strategic path. You heard it here first. Here's a graph that actually shows, I broke up the decades in the 10-year increments and then bisected them into 5. And what you can see from the graph is most recessions occur 90% of the time in the first 5 years of every single decade. And we are in the growth peak phase of the business cycle in the last 5 years of every single decade. We as real estate investors have to be more sophisticated. A lot of us like to underwrite using financial microeconomic theory, such as using pro formas and discounted cash flow analyses and cap rate analyses and sales comparable approaches to valuation. I think that's pretty standard. I think what a lot of real estate investors don't understand is they need to be more sophisticated. They really have to understand the politics that end up becoming law. And then that law gets institutionalized and administered through the bureaucracy that will have both intended and unintended economic consequences, both negative and positive externalities. If you can conduct the analysis and anticipate what the policy outcomes are going to be based on the politics and the enactment of those policies, you can move your portfolios and you can move your businesses to benefit from the positive outcomes associated with those policies. Or you can put together contingency plans and mitigation plans in place to mitigate the damage to your human equity and the equity embedded within your real estate, your security portfolio. So I challenge you to do that. I've also noticed in my research over 10 years ago that I noticed that the institutional arrangements amongst in countries, particularly in the United States, move through these dialectics, either dialectics caused by revolutions or revolts, world wars. Definitely the financial crisis was set off a dialectic. COVID set off a dialectic. Trump's election set off a dialectic. Biden's election is setting off another dialectic. And what's happening is you're seeing institutional rearrangements occurring more frequently. They used to occur every 30 years, but now we're seeing dialectics every 3 years, which is extremely complex and extremely destructive, because every time you restructure institutionally, it costs millions or billions or trillions of dollars to rebuild institutions and realign them again. We have to also be looking at the political framework. This is the mean voter theorem. What we saw under Trump and under McCain and Romney and Bush II, basically a rightward shift in the political ideological spectrum, leveraged not only by cable TV, but also leveraged through Facebook and WeChat and other technologies that have mobilized extreme coalitions on both fringes, but mainly on the alt-right. This is an extremely dangerous mobilization of ideologies that then manifested and was reflected in the riots on January 6th in Washington. This can never happen again. There needs to be a reversion back to the middle, where policy was made for decades, and where policy can be made that will benefit the majority of the population and not just a specific class or a certain extreme constituency. What does this have to do with real estate? It has to do everything with real estate, because at the end of the day, we have to come up with a discount rate or an expected return or a cost of capital. And what we forgot to add on to the construction of the discount rate was political and policy risk premiums. And now with the revision of the tax code, there's now tax risk premiums that we're going to have to deal with. And now we're confronting inflation risk premiums. And if we fall into another financial crisis, we're going to be dealing with credit and illiquidity risk premiums. And the market identifies that political and policy risk premiums are having an effect on their ability to make investment decisions. Even though the investment markets are very healthy right now, it's not because of the information flow is easy. It's because that the Federal Reserve has basically driven interest rates to zero, and the fiscal policymakers have basically issued $3 trillion in debt to pump prime the system. And this is not going to continue. So if we can figure out what the discount rate is, which is in my view, the variable that we need to be looking at, it's become very non-stationary and very volatile, which means that valuations and present values are very volatile. You could see swings in valuations from 50 to 100% in certain real estate sectors and geographies, and then at least a 10 to 20 and maybe a 40% correction within 24 to 36 months later, i.e. the financial crisis. So investment decision-making is more challenging, and that's what I tell my students, is they're going to need to be smarter in making investment decisions, because this is the environment in which they will be operating. There's just more systematic risk that we're dealing with. We used to be able to add portfolio assets to our portfolios, And if the assets that we added to our portfolio had low, no, and negative correlation with each other, we could eliminate the unsystematic risk. And that's all we had was systematic risk. There's just more systematic risk now, which makes it very difficult, particularly political risk. And now we're going to be dealing with fiscal policy risk and monetary policy risk within the next 12, 24, 36 months. So my solution to that is to take on more unsystematic risk, to focus on micro markets that have comparative advantages and market attributes that are unique to that market, to pick quality assets or to be able to value add or do opportunistic investments where you're creating value through the management process, and also having a conservative balance sheet where you can take advantage of opportunities, have really good personnel, and implement and deploy technologies to become extremely productive, and then have clear communications and brand to be able to market to your target markets, to be able to take advantage of the 80-20 rule, where 80% of your revenue comes from 20% of your highest quality clients. If we do a good job of building our portfolios, and this is a hypothetical target portfolio that I believe is relevant for the next 30 to 40 years. So for you young investors, this is basically what your target or model portfolio should look like. 45% bonds, 25% stock, 10% cash value, permanent life insurance backed by a mutual insurance company, 10% direct real estate equity investment, and 10% alternative renewable energy assets. I'm not a proponent of crypto. I don't recommend it because it's a risky asset class. It is emerging into a major asset class. If you're willing to take the risk, then it is an asset class that you probably want to expose to. But be careful of the volatility, because we still cannot calculate the intrinsic value of cryptocurrencies. It's relative value based on the belief of the perceived value of the market participants. Let's talk a little bit about monetary and fiscal policy. The numbers are just astronomical. They're unfathomable. They're incomprehensible. During COVID, the money supply was growing at about 93%, or M2 by 55%. We have to put this in perspective. During the financial crisis, the money supply was growing at 40 to 50%. During COVID, they doubled it. The Federal Reserve knew that this was the most existential crisis that the United States was facing in its history next to World War II. And they acted, I believe, appropriately to put a backstop underneath the depression and the potential asset price collapse that would have collapsed the banking system and made a run on the banking system. So I think their tools were correct. Their method was correct. However, the long-term consequences associated with their actions will be felt for generations, because what you've witnessed currently is the upper 90th percentile of individuals of wealth have seen their wealth either double or quadruple within the last 24 months. And people in the lower 50th percentile have fallen more and more into poverty, and will fall more into poverty as inflation kicks up higher. And we will see more and more people fall into poverty unless education, healthcare, and housing is addressed. I'm also telling my students and newly minted PhDs in finance and economics that they're going to have to study this era, not only of what we went through and what we've gone through over the last 10, 20 years, but we're going to have to come up with new theory, and we're going to have to go back and rewrite the textbooks, because the textbooks are out of date. They are relevant from a certain standpoint, but we've witnessed a dialectical shift. And we will now need to go back and build new models to try to articulate and communicate with the short-term, medium-term, and long-term consequences of what we've witnessed over the last 22 years. The fiscal deficit. We have accumulated $2.8 trillion of debt and deficit over the last 13 months, the highest amount of debt and deficit accumulated since financing World War II. Congress doesn't seem to care. The voters don't seem to care. I seem to care because the only way I see out of it is inflation, which will devastate the lower class. But again, never seen it before, and the debt levels are astronomical per person. And if you look at the statistics, it's about $200,000 per taxpayer at a $26.5 trillion debt and increasing. So it's just, these are just the realities. Because it's a highly competitive global environment, countries like Japan and China, Germany, basically buy US dollars to depreciate their currencies to make their goods competitive in the global trade markets. And what they do is they buy US dollars or repatriate US dollars into US Treasury securities, which drives down the cost of our debt, but increases the concentration of ownership of our debt into a few foreign country hands based on their global trade policies. And a lot of those countries either have some type of fixed floating managed exchange rate as opposed to a free floating exchange rate. But our currency is still the reserve currency where most international transactions are being conducted. However, there is competition with the yuan and the yen and the euro, but the dollar will continue to be the dominant reserve currency going forward unless inflation spooks the market and capital flows start to flight out of the United States into other countries for relief from hyperinflation and stagflation, which could be a possibility, not a probability. Here's the Fed's balance sheet. You could see it went from 800 billion in 2008 to 8 trillion currently and going. This is the 300-pound gorilla in the room. Nobody talks about it. Nobody knows how to talk about it. And when they do talk about it, people get scared. If you look at the Fed's balance sheet, 5 trillion of the 8 trillion is US government treasury securities, so about 65%. And then the balance is mortgage-backed securities. And the Fed has been buying commercial mortgage-backed securities, which narrowed the spreads in both residential and commercial, allowing the commercial and residential markets to maintain their access to cheap capital, which has inflated and created asset price bubbles in both commercial markets and in residential markets. Here's the money stock. So you can see that it's been growing exponentially since the 90s and went vertical during COVID. Here's the money supply growth rate. The Fed used to target money supply growth rates at their target GDP and target inflation rates. So historically, GDP's mean, the money supply growth rate's mean was targeted to 3 to 4%, which is the long-term target for GDP. But the Fed has been targeting money supply at 5%, not 3 to 4% at GDP. So they'd like to run it a little hot. But you can see from this graph that COVID blew out basically, the money supply growth rates, and what we've seen is completely unprecedented supply of the money stock. And here's the other component to the quantity theory of money, which is the velocity of money. The velocity of money is pro-cyclical. It moves with the recovery peak phases of the business cycle. It is highly correlated to employment and inversely related to unemployment, and highly inversely correlated to labor participation rates, which are at basically historic lows. With the advent of shadow banking and electronic payments and cryptocurrencies, the velocity of money has collapsed. The economy and inflation will not get back to its target without the revision or the recovery in the velocity of money. Fiscal policymakers, monetary policymakers have no effect whatsoever on the velocity of money. The only people who have control of the velocity of money is Congress through labor policies. And I don't see any labor policies on the docket. There needs to be labor policies to bring women back into the labor force, along with minorities and young individuals. And there needs to be education policy, healthcare policy, and housing policy, which would actually cure the velocity of money collapse. That's also not talked at all about from anybody. As you can see, inflation is at the highest it's been since 2011, the late 80s, and coming out of the 2001 crisis. So this is some of the highest inflation rates we've seen since probably the 70s. What we've also seen is unprecedented due to all that money pumped into the system. The stock market has reached unprecedented heights. It's definitely in an asset price bubble. And when the Federal Reserve decides to start tapering back its bond purchases or start to invoke quantitative tightening in a rising interest rate path, you're going to see a lot of volatility in the stock market, and at some point you may see a 10 to 20% correction. I'm saying that this could probably happen in 2023 or 24. GDP is currently at around 5%. It was revised down to about 4.5% from 6%. The fear is that the COVID variant infection rates and hospitalizations and death rates is causing manufacturing facilities and office facilities to pare back because people don't want to go to work to get infected. So that's definitely crimping office absorption, office occupancy, manufacturing, and we're also seeing the impact currently on microchip production out of Southeast Asia, and also disruption in the supply chains due to COVID on a global basis. Industrial production collapsed, as you can see, the worst since the financial crisis. It's recovered very quickly because the amount of fiscal and monetary stimulus, so that's positive. It will probably get to pre-pandemic levels probably within the next 3 to 6 months. Non-farm employment completely collapsed due to COVID. It was probably the worst employment market since the Great Depression. Luckily, Congress and the Fed were swift to enact monetary and fiscal policy to put money into businesses and individuals' hands so that they could pay rent, eat, and make sure that millions of Americans didn't fall into poverty. And the employment market seems to be recovering. However, people aren't wanting to go back to work because they're scared, or they are getting financial benefits coupled together. Makes them not want to go back to work. A lot of these workers and a lot of workers were underpaid and exploited anyway. So now they have a comparative advantage to be able to bargain with employers to raise wages, which will be beneficial for the economy in the long run. But again, I think it might be the point where labor has a comparative advantage and can go to the table and ask for the wages and the salaries that they deserve after decades of exploitation. The unemployment rate peaked at 15%. When I look at unemployment rates, I double it to get to the underemployment rate. So you can see the 80s recession of a unemployment rate of 10 or an underemployment rate of 20 was really high. The same thing with the financial crisis. But we hit unemployment rates of 15%. which means underemployment was 30. You got to go back to the Great Depression to see anything analogous to the amount of job destruction that occurred within just months during the pandemic, March, April, of May of last year. The unemployment rate is now starting to approach its natural rate of 5%. It will probably hit that rate within the next 3 to 4 months because the labor markets are a lagging indicator. So we'll probably get back to quote unquote what's supposed to be full employment, but I don't believe it. I believe a lot of people have left the labor force to maybe come back. And the unemployment rate is artificially low because when people leave the labor force, it drives down the unemployment rate. And as people roll off, the unemployment rolls because they run out of unemployment benefits. That lowers the unemployment rate artificially also. And here's the labor participation rate. You could see it was in a secular decline anyway, which is a problem. And Congress did not address this at all. This is a major systemic issue with the US economy, is low and falling labor participation rates. Then COVID hit and it collapsed due to the 2 million women that had to leave the labor force because we have no child care provision here in the United States, which is a shambles compared to any other modern economy in the world that provides health care and daycare and maternity leave for their women. About 800 million of those women have gone back to work, but there's still 1.2 that still aren't employed. And we need to get the labor participation rates back to 66% from basically 60% today. So, and that's going to take congressional policy. And I don't believe Congress has basically the guts to do it personally. Here's non-farm employment in the Bay Area. You could see just a massive collapse. We lost about 450,000 jobs in the Bay Area. We've recouped some of it, but it's probably going to take 2 to 4 years. Just go drive down downtown San Francisco, drive down downtown San Jose or LA or Seattle. They're still ghost towns. It's going to take years, maybe even a decade, to get some of these urban cores back to where they were pre-pandemic, if ever. So this is a major issue that needs to be addressed at the policy level, particularly at the state and local level. Even though local labor policy is limited, it really needs to be done at the federal and the state level to be able to get back the labor back to where we were pre-pandemic. But a lot of those jobs have left. They've been destroyed. New jobs have been created at other locations within the Western region and across the United States, particularly in urban locations, particularly with lower housing costs and lower costs of living. Here is the 12-month change in non-farm employment. You can see it's popped back up, which again is a positive sign. Here's the employment cost index. You can see it's basically gone vertical. That's inflationary. Hourly wages collapsed. They were actually doing very well prior to the pandemic. They're starting to recover slowly, but slowly. Here's productivity. Productivity collapsed after COVID. It is now starting to recover as businesses, since they can't find labor, but they can borrow cheap. What they're doing is they're borrowing cheap and they're replacing labor with machinery, automation, and AI. So this productivity will probably continue to go up as businesses replace labor with capital. Import prices are rising significantly. China's inflation is rising at about 10%. So not only are we seeing inflation here domestically, but our imports are rising significantly because of supply chain disruptions and inflation in export-oriented economies across the globe. Here is a 10-year leading economic indicator. As you can see, it recovered from the pandemic. It looks like it's starting to trend downward, and that could be a stagflationary signal. Consumer confidence in that upper left panel, that's China. China basically shut down its economy, zero tolerance, basically quelled COVID and was able to open up its factories a lot sooner, and its consumer and business confidence was reflected in those policy actions. You can see consumer confidence bottomed and recovered and is still recovering from the pandemic, which is a positive sign. Retail sales, they were negative in April, but actually May, June, July have been positive. And we'll see if retail sales can hold up through the Christmas season, which is critical. The majority of retailers generate most of their revenues during the Christmas season. So we'll see what happens. And the effects of COVID, the second Delta surge, and what that impact will have on retail sales. This is a leading economic indicator. Again, you can see it bottomed out after COVID and is now starting to move up, which is positive. Here are semiconductor sales. We can't get enough semiconductors, so there needs to be some type of industrial policy. The automakers are meeting with the government right now to negotiate with Southeast Asian countries, China, Taiwan, to try to increase supply of semiconductors, because we're losing about 2 million auto sales per year due to the lack of chips coming in the United States to assemble the cars. Also in the maquiladoras in Mexico, where they assemble most of the parts and most of the autos that are shipped back into the United States. Venture capital, the first quarter and the second quarter of venture capital in the United States and in Silicon Valley, I would just say the Bay Area, was the highest it's been in decades, which is positive because most of the firms are concentrated in Silicon Valley and San Francisco that receive at least half of all venture capital raised in the United States per quarter. So that's an extremely positive sign. And you're seeing this flow over into bioscience. And bioscience is one of the hottest sectors right now in real estate, particularly on the peninsula and the South Bay and South San Francisco. Here's your venture capital flows. Again, just spiking. And a lot of that spike too was due to pent-up demand. Due to COVID, people weren't bringing companies to market. They weren't funding companies when we were shut down for that 8-month period. The majority of the money is going to internet app companies, healthcare companies, mobile telecommunications, software, industrial, computer, hardware, business products, services, consumer products, financials, and energy and utilities. So it's the internet and the Internet of Things. And obviously tied to that and the loads that puts on the system is the emergence of the data centers, not only hyperscale, but mid-scale and micro-scale data center networks that are currently being built out. And the data center market is one of the hottest real estate markets right now, next to bioscience, apartments, and storage. Here's our trade deficit. I don't have a problem with trade deficits. It's probably sacrosanct, but probably will never get a job at an Ivy League, economic department. But running deficits to be able to import cheap components to then be assembled into value add components, and to be able to import cheap goods into the United States is extremely beneficial, not only for the global economy and export-oriented economies to prop them up and make them grow, but also to hold down inflation in the United States. And that's one of the biggest problems, is our import supply chains have been disrupted because the Trump administration antagonized Canada, which was a major exporter of lumber and building materials into the United States, that pushed up the cost of construction for homes and the price of homes, but also antagonized Southeast Asia, particularly China, which was a major exporter of goods into the United States, which has not only disrupted the supply chains, but has also created inflation in the United States from that disruption and that dysfunction in our trade policies with China. And I don't see Biden really addressing it. So the supply chains will continue to be disrupted, and we'll probably continue to see inflation in the United States until our policies are aligned with China and we can get them back on board. This is the Case-Shiller Index. This measures year over year the price change in residential. And actually, this is as of, I think, May or June, no, July of this year. Obviously, August was just as high. So we're running at about, depending on the market, between 12 and 22% year over year change in residential due to extremely low mortgage interest rates and basically a flight and out-migration from urban cores into suburban markets driven by COVID fears, but also the ability to work remotely, particularly from tech workers and people who can work remotely to these suburban locations, driving up home prices from their more affordable bases. And you can see the markets that have seen the highest home price appreciation rates, 13.4 in LA, 20% in Phoenix, almost 20% San Diego, almost 20% in Seattle. So this gives you kind of an idea of what markets are the hottest, which would probably be the best markets for rehab, redevelopment, flipping, development in these markets while they stay hot. Although some hot markets pop at some point, so your window is pretty short. Let's keep looking. How am I doing on time, Monica?
Another 13 minutes to go.
Okay, yeah, perfect. Okay, so let's get into the real estate markets. I already painted for you what the real estate cycle and it would look like. Again, rising interest rates in 22, potential inversion 23, stock market peak 23, 24, recession 24, 25, recovery 25 through 30. And then the core markets I like in the Bay Area are the Class A submarkets. They've always been good markets. They will always continue to be good markets. They always have the highest structural occupancy rates, higher rental growth rates, lower cap rates, higher capital appreciation rates. You just got to be able to underwrite them, spot relative value, and be able to move with your capital stack to position yourself. Industrial is one of the strongest markets right now. It continues to be extremely strong, and particularly R&D in Silicon Valley, industrial in Oakland, industrial in the South Bay, logistics in the Inland Empire, and you can go east to Plano, Texas, or Atlanta, or Miami, and play in those markets if you want to. Availability rates are still well below their structural levels, which means that rents are growing well above the local inflation rate, and this will probably continue for at least the next 2 to 3 years. And you can see rents have gone up significantly also, and really no blip whatsoever due to COVID. The top markets for industrial: Dallas, Atlanta, Inland Empire, Phoenix, Chicago, Pennsylvania, Columbus, Houston, Central New Jersey, Los Angeles with net absorption, and then rent growth. Salt Lake, San Antonio, Reno, Las Vegas, Phoenix, Columbus, Louisville, Atlanta, Dallas, Inland Empire. These all make sense. Logistics markets, you can see vacancy rates for logistics in the US is the lowest. This is dominated by Prologis and companies like that. So if you can't buy them, look at taking some exposures in the logistics or the industrial REITs. These are the top logistics markets in the United States: the Bay Area, Seattle, San Jose, San Diego, Orange County, LA, Oakland. So plenty of opportunities in the West. The apartment market, again, very strong. Although vacancy rates are rising, they're still below structural, which means that rents are still growing above the local inflation rate. Actually, what we're seeing in some markets are rent spikes for the first time since probably Um, we really didn't see rent spikes in the last cycle. We just saw accelerating rents. We did see rent spikes in 06, 07, and definitely during the dot-com boom, but we're seeing rent spikes in some markets of 12 to 24% for the first time since really, the 06, 07 and the dot-com boom in the late 90s. And actually, people are starting to migrate back into or close to the urban cores. I think they're fed up with living in, Boise and Billings and some of these areas, and they're starting to reposition themselves and move back, or start to look to move back towards the urban cores, or at least the suburban urban cores, to start to position themselves to move back into the cores. Net absorption is still negative, which is putting upward pressure on vacancy rates, but as you can see, it looks like it's reaching an inflection rate. And if I had this updated, I know that the net absorption rate would be less, and eventually it's going to turn positive within the next 12 to 24 months. Here are the top markets for rent growth. Inland Empire, again, coming off of a low base. Sacramento, again, coming off of a low base. High immigration, into these, or in-migration into those locales. Ventura, that's a small market, but a Gucci market. San Diego, Portland, and then you're getting into some of the other markets, which is interesting. San Francisco, San Jose, LA had major corrections. These are reversing very rapidly. However, the recovery in those markets have stalled due to COVID. Until we solve COVID and have federal, state, and local mandatory vaccination policies for everybody, COVID is going to continue to disrupt the capital markets, the economy, and our real estate markets. So please call up your Congress people and tell them to start mandating that everybody get vaccinated. And then the investment volumes are starting to recover after bottoming out in 21. The office market, this is a survey that was done. The reabsorption of 70% of the leased space was to occur this month. It hasn't occurred because of COVID. So you're going to have to push this out probably till next year. So the office market recovery has been pushed out a year due to COVID. Sublease space is still peaking, which is putting downward pressure on prices. Rents, I haven't seen really prices correct yet due to falling rents and collapsing physical occupancy rates. There may be a shakeout this or next year, we'll see. But with financing basically being zero and subsidies to corporations to carry the space, the prices aren't going to adjust. But I think there are relative values out there if people want to take positions. And I know that foreign investors are eyeballing some core trophy properties in the major markets in the United States to pick up some assets below replacement costs. But sublease space is increasing, but increasing at a slower rate. Occupancy rates are still continuing to fall, but looks like they're bottoming. Rents, you can see this is on a global basis. Some of the rental corrections are the worst in San Francisco and LA. Hong Kong, because it's a financial center, it's exposed to China, and because the political unrest and the political situation there is making it less attractive to be located in Hong Kong as opposed to Singapore and Tokyo and other Southeast Asian money center locations. Retail has recovered, although COVID has had an impact on it, and the second wave is having an impact. But significant sectors have fully recovered and are actually thriving in certain retail segments in certain retail locations. So it may not be a bad opportunity to pick up some retail assets, remix it, as long as COVID doesn't shut things down. I think there's enough people vaccinated where that may not happen. But again, COVID is spiking, particularly in the inland areas, and it could have major impact on retail centers within the valley, in the valley. Absorption is starting to recover. Leasing activity for retail is recovering. Prices are still relatively flat compared to other sectors. If I'm going to pick markets to go into for retail, I'm going into the ones with the highest inflows of migration, which is Phoenix, Atlanta, Houston, Dallas, Vegas, Austin, Orlando, Tampa, Charlotte, and Nashville. Data centers are one of the hottest sectors right now. I can't buy a data center, but I can buy data center REITs. And Northern Virginia, Chicago, Phoenix are the top markets. And if you go global, it's Singapore, London, Sydney, Frankfurt, Dublin, and Seoul and Tokyo are the top data center markets. And this is going to be a hot market for a while due to the apps and due to just the load that's being put on the internet. Life science is a hot market too. These are the top markets in the US. San Francisco, San Diego, Seattle, LA, Denver. Adaptive reuse is the play these days, picking up office buildings that are physical and functionally deteriorated and obsolete and turning them into value-add life science lab and incubator spaces. And again, here are the top life science markets if you want to target those for acquisition. The investment market is recovering overall for real estate. Volumes have bottomed and starting to recover. The top metros for investment in the US are LA, Boston, San Francisco, New York, Dallas, and Phoenix. Also LA, New York, and the Bay Area. The top markets for investment in the Bay Area, in my view, Mountain View, Los Altos, Central San Mateo, Russian Hill, Embarcadero, Sunnyvale, Marina, San Francisco, Pacific Heights, Walnut Creek, San Mateo, South of Market. Those are your top core markets, and I'd be buying properties close to those core markets because the progression will pick up that demand through revitalization and regentrification. And then lastly, capital flows into commercial real estate, as you can see, are trending up, similar to the trend from 2001 to 2008. So capital flows will continue, in my belief, into real estate for at least the next 5 years. The financing sources right there now, particularly residential, is Fannie, Freddie, and HUD financing. Real estate investment trusts have recovered, so the REIT market is very active. If you invested in REITs over the last 20 years, you got basically a 15% annual return. You almost doubled your money every 5 years. That's extremely attractive. The markets that got hurt the most during COVID, such as retail, have fully recovered. Commercial mortgage-backed security spreads have narrowed and are still tight, so there's plenty of conduit financing out there to keep the capital flows going in residential and commercial. And that's basically it.
Thank you very much. That's very, very comprehensive. Yeah, that's a lot to digest. So luckily that you allow us to send out the PDF of your presentation. Yeah, so I think there's already like some of our audience asked for the copy. Yeah, definitely by early next week, we're going to send out a copy of the presentation as well as the recording. There's so much to digest. So apart from that, I do have some questions for you, Larry. Well, other attendees, if you have your question, please type in the chat box. So with the new tax rule that is coming, in particular, Newsom, our Governor Newsom has signed off on SB 8, SB 9, especially SB 9 and 10 about like possibility of making the single family home to be like a duplex. You can build additional unit easily, not just the ADU, but even turning the zoning into a duplex. Or you can subdivide a parcel easier than before. How do you see the impact of this new rules on the Bay Area real estate?
Well, of course, the NIMBY coalition, is going to be adamantly opposed to it because they don't want higher density in their neighborhood. So there will probably be some, political and cultural backlash to it because, the system is basically segregated anyway. So it's just issues that we've dealt with, for generations. It's definitely a positive from a density standpoint. We're in a housing crisis. We've been in a housing crisis for decades here in the United States, particularly in California and the Bay Area. So it's definitely a positive. And I think there can be a compromise. I mean, there's beautiful product out there that can be developed, that could situate product, that conforms on the site to mitigate, any environmental damage or any design damage. It will be just up to the, planning commission and the, zoning codes, and, individuals to allow for, these types of units to be built. I look at it as an opportunity, from a real estate investment standpoint, but also to be cognizant to if you're going to do it, don't build crappy real estate and piss people off. Build beautiful product that's cognizant to the sensitivities of the neighborhood, and build an amenity for the neighborhood. And I think that should help to mitigate the stress, that a lot of neighborhoods will probably, go through.
Yeah, I totally agree with you. And also, like you mentioned, that there's a possible that we might be going into recession in 2024, and then we are going to see kind of some adjustment in the stock market. Like for most of us attending the event today, we either a homeowner or investor home real estate in the Bay Area. So with all those political and economic change in the market, how should we be preparing? Because they also been talking about like capping the 1031 exchange to be at 500K. So should we be kind of like holding on, or should we kind of 1031 exchange?
Well, again, I can't really give that advice, because that's really that's really something you need to talk to with your accountant, from an accounting standpoint. Just best practices, review your property if there's any deferred maintenance or functional obsolescence that's curable, to consider, curing it. Reviewing your leases, and assessing the tenant credit risk, and default risk, that you're confronting. Reviewing, what is the property sector or property type, that you're invested in, and what is the probability, of being able to write probably at some point, or maybe it's now longer term leases, with some bumps to get you through the potential recessionary scenario, in the next 5 years. And then to probably deleverage, the property. So if you are confronted with a tenant credit default that's going to impact your economic occupancy, that at least if you are multi-tenanted, that if a tenant defaults or rents, fall along with occupancy rates, that you're conservatively leveraged enough to be able to cover, your mortgage payment plus, so that you don't default on your mortgage and have to go back and restructure the loan with the bank, or worst case scenario, if it's a nice property, the bank will probably take it.
Got it. Well, impact regarding the impact of COVID, and we continue to be having a lifestyle being, affected because of the pandemic situation. And I still have many of my clients or my friends still kind of like staying away from like eating out, and, of course, going out as little. Sometimes it's, just take delivery instead of going to grocery. So for the impact on the commercial sector, like you mentioned about downtown of San Francisco or Seattle have been quiet. And so like, do you see a major change of like retail malls that we see like still a lot of people kind of like looking at triple net, but retail malls, some of those offerings, would that be a good timing to consider?
Well, if you have the capital intensity, and the vision to create mixed use, and you've got support, from the local, politicians in the community and the jurisdictions, I've always thought that there was mixed use, redevelopment opportunities with a lot of these regional malls, and you're seeing it at Stonestown kind of emerge along with Park Merced right there in San Francisco. I think that's a leading indicator. I know that Northgate Mall, in Marin is looking at working with developers, to redevelop that site, to reanimate it, because a lot of these local municipalities relied on, and promoted retail for their tax base. Well, retail is impaired, commercial is impaired in some of these locations, particularly from office buildings. You're looking at a shrinking public finance and tax revenue base. They're going to need to do something about it because their bureaucracies have ballooned, over the decades. And those employees that are either currently hired or going to be retiring are going to be retiring with full benefits. So you have these huge pension liabilities that these local municipalities are not going to be able to carry, along with the capital investments that it also is going to be necessary to invest in schools and roads and other infrastructure at the local level. So municipalities are going to have to wake up from their myopic sleep and start to reanimate and reconfigure land use within their cities to conform to the realities of a post-COVID environment.
Gotcha. So like many of our investors now are looking beyond Bay Area investment, especially because of the AB 1482, the statewide control, the rent control. And also we have been going through like tenant rent moratorium during the COVID time. Now, like many people are looking at out of state cities, some of those like you mentioned, such as like, say Denver or Austin or say Tampa, some of those areas. So like, do you foresee that the migration pattern, especially even, right now we're still dealing with a pandemic, but like as people are looking for less expensive cost of housing. So is it a trend that you can see that migration of the people to the suburban area with job potential will continue to grow? And also like we see the housing actually gone up quite a bit in those areas.
It's always been the case. I mean, if you look at, population growth, in California, going back the last 20 years, when we had more liberal immigration policies, the foreign immigration, population growth basically negated the out-migration. So we still have positive population growth here in California. The problem is now we have no immigration policy, which is not good. And two, you have out-migration. So you're actually seeing falling population and negative population for the first time. And actually some cities and some counties, particularly in the South, but also here in California, are seeing more deaths due to COVID than births. So you're seeing, shrinking population. Out-migration has occurred always from California. It's just accelerated over the last 24 months due to COVID. I think as people become inoculated and vaccines become more widespread, if we can bring down infections, hospitalizations, and deaths, that out-migration will probably slow too, but it will probably continue into perpetuity. In the question of what markets will be fielding these, again, bordering states, both desert and mountain states from California, are the most logical recipients of these migrants. But wild cards of absorption of these migrants will be more cultural as opposed to economic. And you can really see that in regards to Florida, Arizona, and Texas, where they have resorted to very extreme right-wing political policy ideologies, such as restrictions or really banning of abortions, restrictions on voting rights, restrictions, on other cultural and political rights. And then it becomes an issue for real estate capital to do a cost benefit analysis and figure out, is the cost benefit still positive considering the policy implications associated coming down from the state level.
Yes.
Some major tech employers have basically stopped expanding in Austin because of what Texas has done on abortion and voting rights.
Really? Wow. Yeah, but like we definitely follow, the extreme right-wing measures that they've been adopting. Yes.
Yeah, that's just the environment. So, what I talked about earlier about having us have to move to the legal, political, and public administrative aspect. That's an assessment. Those are aspects of your underwriting that you have to take into consideration. You have to make either you care or you don't care, and if you care, you have to weigh the social and moral and ethical consequences associated against the economic consequences or the economic benefits.
Yes. Well, with the proposal of the new tax rules that might be passing through Congress, there will be a lot of new taxes. And being Californian, we're paying very high tax already. But then there would be continue more, especially they even talking about like getting rid of the step up, like when the
sure.
Yeah, either gift tax or death pass on estate. So we are seeing the trend. A lot of people, like you said, they're moving to the bordering states like Nevada, or
sure.
someone moved to Washington because of the tax.
Sure, the cost of living.
No state tax.
Yeah, the cost of living is cheaper.
And all this.
Business is cheaper. Although water is an issue now for all of us. Go ahead.
Yes. So, like, do you see this trend continue? Like cities like Las Vegas have been attracting so many Californians, and also, like you mentioned about, say, Boise, Idaho, some of the other areas. Is there anything that you would observe politically that California government might be taking measures to kind of like able to maintain some of the their residents to kind of attract them to continue to stay here?
Well, again, the attraction to California, as you've seen, home price and commercial real estate price appreciation. The multiples are higher, both even human capital. People can come here, invest, benefit, or even work, benefit, and then arbitrage their equity at some point in time someplace else. California has very high quality of life. You've got the mountains, you've got the ocean, you've got an amazing city college or junior college network, a state and UC network system, along with the private school network system. The educational system in California is unprecedented, which creates huge opportunities for businesses, to operate here. Businesses who operate here are more productive to be able to handle the higher costs along with the higher taxes. So it's really based off of, are you a business and an individual that's productive and profitable enough to basically justify having a location here, or at least a core component of your business located here, and then you have some type of hub and spoke system where maybe the core operations are here strategically, and then you have satellite operations in Seattle, Portland, Phoenix, Salt Lake, Boise, other satellite cities that create a network. Mm-hmm. And I think that's, and I've been talking about that for for decades that this would have eventually happened, and COVID just accelerated everything by 10 years. All the trends that were in place were accelerated 10 years within the last 10 months.
Yeah, we
we don't even
see it happen.
And we don't even recognize it because this is a dialectical shift. This is what I was talking about earlier. The institutional frameworks that have set off the dialectic, we don't even, the speed in which the change has happened, we don't even recognize. It usually takes, a decade, for people to realize how much has changed and then to adapt and realign with the institutional and the environments that have been realigned.
Yeah. So many of my clients and also my members, their parents, grandparents. So if you're thinking about in this particular juncture that you have to kind of like strategize. You mentioned about like more taxes coming, more debts are being shouldered by the children or grandchildren. So what measure would you take now in order to kind of like help your generation to come to kind of like lead a better life by doing something that you could start doing today?
I would get if it's possible, get an unbiased investment advisor, somebody who's independent, can look at your whole portfolio, your everything, not only you individually, but your kids and your grandkids and your great-great-grandkids. Look at your real estate asset, look at your equity assets, look at your insurance, look at everything. Look at your tax and trust structures, look at your trust situation, look at your, irrevocable, your living, trusts, your wills, your medical situations. Get all of that stuff in place now as soon as possible. Get your kids and your grandkids on board, get all of that stuff straightened out over the next 12 months. Because if something happens and you're unprepared, you're not going to need an investment advisor, you're going to need an attorney. But you should have a trust attorney and a tax attorney and a trust accountant and a tax accountant and an advisor and a broker. You're going to need, people around you. And either that independent advisor can project manage your situation, or you're going to have to do it yourself. But you need to get those things in place, because if something happens and you're unprepared, you're going to be reactive as opposed to being strategic, in your decisions, and it's going to be extremely costly. And the worst case scenario is something happens and it blows up the family, and you blew up the family because you didn't have everything in place. Because the kids start arguing and fighting over the assets. And the family,
that's very good advice.
The family's destroyed. I've seen it. It's awful.
Yeah. So it's time to plan, to seek out professional help, on all different like legal, finance, and also estate as
and then talk to your kids too. I mean, ask them what they want, and if they don't want it, then like you said, you can you can exchange into a triple net. You can go into Delaware statutories. There's other ways of exiting real estate so that you can have a better life. I mean, you guys work so hard to accumulate assets. At some point in time, you got to enjoy the rest of your life.
Yes, totally agree. So we do have a question here. So say, when migrating from high living cost area to a little relatively inexpensive living cost area, people would encounter more changes in terms of benefits versus social and cultural environments. How do you balance and handle these new changes?
That's a good point. Probably the first is to do research, and to do research on those qualitative factors, and aspects that aren't quantitative, that are more nuanced, so that you can, make an intelligent decision if that's the right location and the right place that you want to go to, um, and then be prepared. You know, maybe even do some pilot testing. You know, of going and staying in that location. You know, for a weekend or a couple weeks, or visiting it so that you can get a feel for not only the economic but the cultural and social environment in that area, and see if it's something that that you would be interested in. That would make you happy, right, Monica? I mean, hell, we work so hard in our
Yeah.
life. Happiness is really what we should be pursuing at the end of the day.
Yeah, I totally agree. Yeah, it definitely. We've seen some of my clients already moved to Vegas, so I would contact them every now and then and see how their new lifestyle is. And some of them absolutely love it because they
Really?
have done their study, and yeah, and also they love the part they save a lot of taxes too.
Yeah.
So
Yeah.
yeah, so it really depends on the people. And also we have like some clients, they moving to Florida and
Yeah.
they like it too. Again, like say
Yeah.
moderate climate and also fractional cost of living.
Yeah.
But of course, it's not for everybody. So
Yeah.
I agree. Yeah.
Yeah.
But
Do your due
definitely,
diligence.
yes, definitely. I think it's very, very helpful. I have to say that your presentation is very, very comprehensive and one of the best, and like more research oriented with so many different data to support. And we always learn a lot from what you're sharing with us. And I have to say, many, many thanks, for putting it together. And then it would be just the starting point because so much information on it. And I'm sure that once we circulate it, many people will read it in details. And would it be fine if I include your personal email address, and then the information so they can reach out to you in case they need some private consultation?
Yeah, absolutely. Would love to work with any of your clients and your prospects. And thank you for being generous in making that offer.
Yeah, it's definitely my pleasure. Yeah, good. So like for everyone, we're going to send out the presentation and recording together with Dr. Larry Seuss's email and information. So if you have further questions and if you'd like to consult Larry on your personal scenario, please email him or call him directly. Okay? Yeah, thank you so much again for your time.
You're welcome.
And so, yeah, we look forward to seeing you again, and take care. Thank you.
Great.
Thank you,
Hope
everyone.
Hope to see you in person soon.
Yeah, I hope so too. Thank you.
Thanks,
Bye-bye.
Monica.